From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And the next strategy that we're going to talk about is the bear spread. Unlike the bull spread, this is the opposite of the bull spread. This is the bear spread. Now, we're going to implement this strategy when we are, what, bullish, bearish, sideways-ish?
I'm going to guess bearish, hence the name bear spread.
Ah, yes. It makes it easy to remember.
It's not only easy to remember, but if you understand the bull spread, you're going to be able to understand the bear spread. The mechanism, the mechanics of the actual trade work the same way as the bull spread, except with the stock going down.
All right. Well, what are some of the advantages? I mean, it's cost efficient, right?
For sure. Very cost efficient. It's a safe way of getting short.
Right.
You know, because there's not too many ways an investor, without having to put out a lot of money, can get short.
Right.
A bear spread is one of them. It's a fully hedged position, so if the thing does go against us, the stock moves against us, we do have a limited potential loss.
Right.
We also have a real high rate of return. We know that because, you know, we take a look at these spreads. You know, you're buying a $3, spread for $3, it goes to $5. You know, you just made $2 off a $3 spread. It's a 66% return in just a month.
Right.
You know, we also have the fact that, you know, with the bear spread, like the bull spread, it can be constructed to be a premium collector, which gives us a higher probability of success, because now not only do we win if the stock goes in our direction, but we also win if the stock stays still.
Right.
And even if it goes against us a little bit, we could still win.
Right. So, I mean, that's the advantage of trading options. You understand technical analysis, you're stacking the odds heavily in your favor, but then let's just say you're not absolutely right about it. You might be just partially right about it. That's when these strategies come in, because they come in handy, because you don't have to be dead right, and when you're wrong, you're not necessarily dead wrong. You could still be wrong and make money, which is my favorite strategy, because sometimes I'm wrong.
Well, if you're going to make money when you're wrong, I would hope that you'd be wrong more often. But let's try to avoid that.
Try to be wrong as often as possible.
No, then you'll probably make a lot of money doing that. But let's try to be right.
It's great advice.
And let's do the right thing, the right way, for all the right reasons, and then take our chances.
Well, I can't wait to see this performance, Ron.
Well,
I'm very excited right now.
You're giving me the confidence to go out and really, really knock them dead.
I'm excited. You're confident. I think it's the perfect time for you to get out of here.
And I'm happy that you're excited, and I'm confident.
Good. I have confidence in your excitement.
Thank you. In continuing with our section on vertical spread strategies, we're going to have to talk about now the bear spread. The bear spread is very much like the bull spread. The one thing you have to remember is that no matter what trouble you have trying to get comfortable with trading a down strategy or a bearish strategy, something that makes money when the stock goes down, all you need to do is remember the bullish strategy and spin it around. Bear spreads mechanically work exactly like bull spreads, just in the other direction. You're just flipping them over. So if you have to, think of how the bull spread works, take a breath, and then apply that same mechanism to the bear spread. So let's construct the bear spread. First, we have the long put spread. That's going to be our debit trade. We're actually going to pay money to buy the long put spread. Now, what are we going to do? How do we construct that? We're going to buy a put with a higher strike and then sell a put with a lower strike in the same month in a 1-to-1 ratio. We're going to be buying the put that is more expensive, selling the put that's less expensive. That means we're going to have a capital outlay on this trade. That's why it's a debit. The other construction is going to be the short call spread. That's going to be a credit trade. We'll be bringing money in. We're going to buy a call with a higher strike and sell the call with the lower strike in the same month in a 1-to-1 ratio. Again, we're in a situation where we're going to be receiving a credit. We're going to have a call with a higher strike, which we know is less expensive. We're going to sell a call with a lower strike, which we know will be more expensive. If we're selling the more expensive one and buying the cheaper one, we are going to see money coming to us. There's your credit. Remember, just like the bull spread, The bull spread's debit trade and credit trade were synthetically equivalent trades. That remains true here in the bear spread. What kind of function are we talking about here? Well, bear spread doesn't take a brain surgeon to figure out that bear spread is a bearish position. We are going to benefit from the downward movement of the stock. We also have a position here that's fully hedged. Like the bull spread, the bear spread has a limited potential risk. That means no matter how much further the stock goes up after you hit your point of maximum loss, doesn't matter. You can't lose anymore. The stock can go to infinity. Doesn't matter. You will have already maxed out the major part of your loss on your bull spread. You just can't get in trouble with these types of trades because we have that limited loss, fully hedged position. It is extremely cost efficient in use of expensive stocks. We said with the bull spread that one of the beautiful things that an investor can embrace about the bull spread is that all of a sudden I'm in a position where I don't have to spend a lot of money, even if I'm doing a spread on an expensive stock. If you think Google's going to go down, it's kind of tough to really engage in any type of position in Google without it being expensive. But vertical spreads are different, and our bear spread will allow us to inexpensively trade Google and try to take advantage of a downward movement if we're using the bear spread. It's also great for high volatility situations. Both of our vertical spreads really are effective in high volatility positions. Why? Because we have the opportunity to control our Vega. Where's Vega the highest? At the money. So if Vega is highest at the money and I sell the at the money, regardless if I set this bear spread up as a credit spread or a debit spread, if I'm short the at the money, I am going to have an overall short Vega position, which is beautiful because in a high volatility situation, we could expect reversion, mean reversion. If that's true, it means volatility will probably come down when we're in our spread. And if we're in our spread and volatility comes down and we're long Vega, we would get hurt. Here, we have the ability to control our Vega through our short option. That's why the bear spread, along with the bull spread, are so good for high volatility situations. We can always construct any vertical spread as a premium collector. Debit, credit, doesn't matter, as long as we're short the at-the-money strike. Now, you might say, hey, I have an out-of-the-money spread, so I really don't have an at-the-money strike involvement here. Fine. As long as the option that you're short is the closest one to the at-the-money, you're still going to be in a premium collection trade. So we have the ability to collect premium in our bear spread. We obviously have a high probability of success. We know that we can make money when the stock goes in our favor. That's easy. Every strategy is like that. But here, because of its premium collection ability, when we put on a bear spread, we actually can set it up to where if the stock doesn't move at all, we still make money. And there will be some situations where you can set it up where the stock actually goes against you a bit and you make money. So this bear spread has a very high probability of success. Profit and loss. Well, the first thing we have to talk about when we come to profit and loss is break-evens. And the break-even of a bear spread is calculated mechanically the same way the break-even of a bull spread is. Our break-even is obviously the point where the position doesn't make money, it doesn't lose money. It breaks even. Once we have that calculated, we can start looking at our point of maximum profit. Now, we've talked about this about 150 times, and you're probably tired of hearing me say it. But the fact of the matter is when you are in a position where you have a short option, your point of maximum profit will be the stock price directly at the short option strike at expiration. That is true here again in the bear spread. Point of maximum loss, Same as the bull spread, but the same general rule that always applies in option trading. When we are thinking about where we want the stock to be, when we're long an option, the first place we know where it shouldn't be and we can't have it be is directly at the strike. Here again in the bear spread, that holds true. We don't want the stock closing directly at the strike at expiration, the strike of our long option. So maximum profit, stock at the short option. Maximum loss, stock at the long option. Let's get into our break-evens here and figure out how we're actually going to calculate these things. First, long put spread. That's going to be our debit spread of our bear spreads. We're going to be long the put strike minus the spread price. So if we're in the 25-30 put spread, we know, and we're long it, we know we're buying the 30s and we're selling the 25s. If we look to which strike is our long strike, which will be the higher strike, the 30 strike in this case, minus the spread price will give us our break even. So if we have the 25-30 put spread on and we bought it for $3, we take the higher strike, our long put strike, 30, minus the spread price of 3, gives us a break even of 27. That easy. Now let's take a look at the short call spread, the credit side of our bear spread. The short call strike, which is the lower strike, plus the spread price. So if we're looking at the 25-30 call spread, we're going to be short the 25s and long the 30s. Take the lower strike, the short strike, the 25 strike, and add the price of the spread. If we had, say, taken a $2 credit in, that's where it traded, $2. We want to add that on to the lower strike. The lower strike being 25, price of the spread $2, our break even will be 27. As you see, the break even matches in both. Why is that? And it happened in the bull spread also. Because these two trades are synthetically identical. They have to have the same break even. Point of maximum profit. For our long put spread, we know where the stock needs to go in order to max out our profit. What was the rule of thumb? We know that if the stock goes and closes at expiration at the higher strike, what's going to happen here? We're going to lose. We need the lower strike to come into play. We need the stock price to close at the lower strike or below. So when we're looking at our long put spread, we're long the 30 puts and short the 25 puts. We want the stock to go to 25 or below at expiration. That will be our point of maximum profit. And that makes sense, doesn't it? Because we know that whenever we have a position that has a short option in it, our point of maximum profit is always the stock closing at expiration at the short strike. You're going to notice the same is going to be true for our short call spread, the credit side. We want the stock price at the short strike, which is the lower one, or below. We want to have the stock close 25 or below. That's where we benefit from our short call spread. If we have the 25-30 call spread on, we're going to be short the 25s, long the 30s. With the stock closing down at our short strike, we're guaranteed of our maximum profit. Point of maximum loss. Well, that's going to be the other side of things, isn't it? It's going to be when the stock closes directly at our long strike. For our long put spread, the long strike is going to be that upper strike, isn't it? It's going to be the 30 strike. We're long the 30 puts, short the 25 puts. If the stock closes at 30, where we're long or above, we will have our point of maximum loss. Meanwhile, with our short call spread, if by chance the stock closes at our long strike, which would be what? The upper strike, the 30, we are going to wind up having a loss. And what kind of loss? Our maximum loss. That's exactly what we want to try to avoid. That's why it's important to know that we need to have a good idea, technically, of where the stock is most likely to go before hopping into a bear spread or a bull spread. These are spreads that do have deltas. I know a lot of people say that they're kind of like a delta neutral strategy when they're done out of the money. But they have deltas. They are directional plays. You always have to remember that. And you need to know where you don't want the stock to go as much as you need to know where you do want the stock to go. Here's a little chart of our bear spread. What are we looking at here? Well, obviously, we make money when the stock goes down. Bear spread. Up here, when the stock goes up, what do we have? We have a limited potential loss. Limited potential gain on the way down, limited potential loss on the way up. What's that point right there? That's going to be the point directly in between the two strikes, isn't it? Where the value of the spread is simply the intrinsic value. Remember we talked about that in bull spreads? You're going to see the same thing in bear spreads in a few minutes. Here's our two strikes we're trading. Here's going to be our lower strike. And as you know, we said stock at the lower strike or below, we're at maximum profit. Here's our upper strike. And remember what we said, stock at the upper strike or above, maximum loss. Now, just like the bull spread, the bear spread has discounts and it has premiums. We know that when the stock is directly between the two strikes of a bull spread, it's going to be worth half the distance between the two strikes. So if we've got the 25-30 spread on, it's a $5 difference between 25 and 30. If the stock is directly between at 27.5, the value of the spread should be $2.50. It's true here too. Works the same way, except we're going to notice that our discounts are on the other side of the equation and our premiums on the opposite of where the bull spreads would be. But mechanically, it works the same way. Why? Because if the spread is $5 wide and we have the stock directly in between, $2.50 away, equidistant from both strikes, the extrinsic value of the two options should be equal. And if I'm buying one and selling the other, the extrinsic values should cancel each other out, only leaving the intrinsic value of the options. Well, if one is out of the money, it won't have any intrinsic value. That means the value of the spread comes down to the other option, the one that is in the money. And that one that is in the money is obviously going to be worth half the distance between the two strikes. It doesn't just work with a $5 spread. You could do it with a $10 spread, $20 spread, $80 spread, whatever type of spread you want. If the stock is directly between the two strikes, the value of the spread at that moment in time will be half the distance between the two strikes. Now that we have that midpoint, we have to understand that the spread will be worth a certain amount above the midpoint, a certain amount below the midpoint. And what we need to see is that when we're in our bear spread, if by chance the stock trades above the midpoint, stock is trading in our example we've been using higher than 27, because 27 is the midpoint of 25 and 30. If the stock is trading up at 27.5, our 25-30 spread will be trading at a discount to its intrinsic value. It'll be trading for less than the innate value indicated by the spread. We need to know that, because what's happening is that we're watching this spread as time goes by gain value as expiration gets closer. We can buy it for a discount, the stock won't move, but the value of the spread will increase because we bought the spread at a discounted price off of its intrinsic value. This is why a vertical spread constructed the proper way as a premium collector can make money with the stock not moving. And it can make money even if the stock moves against it for a bit. So when the stock trades above the midpoint for the call spread or below the midpoint for the put spread, we're talking about the put spread right now, but this is pretty much one of those rules that you can write down because it is a rule that works across the board in every spread you have. If you got a call spread and you're above the midpoint, then you're trading at a discount. If you have a put spread and you're below the midpoint, you're trading at a discount to the intrinsic value. Let's take a look at that. Let's say we have a put spread on. And what kind of put spread do we have on? A long put spread. It's a bear spread. We expect the stock to go down. If the stock is located in between the midpoint and the lower strike, then we're going to be seeing that spread trading at a discount to its intrinsic value. We might see the stock, say, at 66. And you might say, well, if the stock is at 66 at expiration, the 70 put will be worth $4. The 65 put will be worthless. The spread would then be worth $4. But right now, with time still to go, that spread will be trading for less than $4. $3.60, $3.40, maybe even $3, depending on how much time until expiration and exactly where the spread is in relationship to the stock. Meanwhile, the premiums lie on the other side. Let's take a look about the premiums. What do we know again? We know that if the stock is in between the two strikes, with the stock directly between, the spread's going to be worth half the distance between the two strikes. We're looking at a $5 spread. Spread is going to be worth 2.5. Now, when the stock trades at the midpoint, we know the value. Half the distance between the two strikes. When it trades below the midpoint in a call spread or above the midpoint in a put spread, then we know that spread is going to be trading at a premium over its intrinsic value. Let's take a look. Here we have this, again, the 70-65 spread. Stock, 67.5, that's the midpoint. With the stock at 67.5, we know that this spread's going to be worth $2.50. $5 wide spread, half the distance between, $2.50. Now, if the stock is located above that midpoint, somewhere closer to 70, we're going to notice that that is going to be trading at a premium. If it's trading at a premium, it means that it is trading with extrinsic value, more than the intrinsic value alone. That premium will eventually, by expiration, decay. And the spread will then be worth only the intrinsic value. Potential returns. The return on any bear call spread is calculated by the amount of profit we make divided by the amount of money we have at risk. For the bear put spread, same thing. The difference between the two is that when we sell the bear call spread, we are receiving a credit. We're not putting money out. So this might fool you a little bit. What you need to know is how much did I bring in, and take the difference between that and the difference between the two strikes. If I'm bringing in $2 on a $5 spread, how much could I lose? Well, if I sold it at 2 and it could go to 5, I could lose $3. That then is my money at risk. So if I make the $2, I made $2 against a $3 investment because that's my money at risk. When we buy the bear put spread, that's easy. How much did we spend to buy it? How much did I make? You know the numbers. That's the easy one. But remember, when we're looking at potential returns for any credit trade, we've got to remember that it's not so much what we're bringing in, but how much we have at risk. That is what is our investment. And we need to know that number. Return example, bear put spread. We buy the 65 put for $6. We sell the 60 put for $3. Well, by definition, that fits our bear put spread, right? We're buying the deeper in the money put. The right to sell at 65 is obviously more valuable than the right to sell at 60. We're buying the in the money. We're selling one that's further away. When we buy this one, the 65 put for $6, and sell the 60 put for $3, we have a debit. This is the debit side. We have money going out. Our maximum gain is $2. The differential between the strikes minus the amount that we spent, our debit. We spent $3 on a spread that could be a maximum of $5, right? The difference between the two strikes is $5. This spread maxes out its value at $5. We paid $3. We could go to $5. That would give us a $2 gain. Our maximum gain is $2. Our maximum loss is easy here, $3. We spent $3 on a spread that can go to 0. If it goes to 0, we lose the $3. That is our net debit. Remember, anytime we buy something, the most we can lose is the amount we spent. That's the beauty of option buying. You spend it, that's all you can lose. Our return. This one's easy. We know we spent money, so we have that money that we spent that's at risk, $3. We made $2. That gives us a 67% return. What about the bear call spread? Now we're going to be selling the lower strike call and buying the higher strike call. Why? Because the lower strike call is going to be more valuable. We know from our beginner class that the lower strike call has more value than strikes that are higher than it. So we're going to buy the 65 call for $1, sell the 60 call for $3. By selling something for $3, paying $1 for something else, we have a net inflow, right? We have a credit. This is a credit trade. The bear call spread is the credit side. How much did we bring in? $2. Whenever you sell something in the options market, the most you can make is the amount you sold it for and no more. Here we sold this spread, the bear call spread, we sold it for $2. That $2 credit is also going to be our maximum gain. Our maximum loss is $3. Why? This spread here is a $5 wide spread. We know it maxes out full value of $5. If we sold it for $2 and it just so happens to max out at $5, then we will have lost $3. Our maximum loss is $3. Now, if our maximum loss is $3, that is our money at risk. If we make $2 while risking $3, we again have a 67% return. Remember, whenever we're looking at a credit spread, you can't look at the amount of money you generated as your investment. It's the amount of money you're risking that is your investment. And when we sell a $5 spread for $2, we know we have $3 at risk. Now let's get into the Greeks of the bear spread. What you're going to realize is the Greeks of the bear spread are going to look very similar to the Greeks of the bull spread, except for one. And that one is delta. The bear spread is called a bear spread because it's a bearish spread. It's this bearish position. We've got a short delta. In the bull spread, we had a long delta. They are directional. Up, bull spread. Down, bear spread. And that's shown right here in your delta. But now, after this difference, the delta, we get to some similarities. Gamma being first. I'm sure everybody remembers that line. What's your gamma? It's determined by the stock's price's proximity to the strikes. We have two strikes involved in this vertical spread, like we did the bull spread. We've got a long and a short. And we know that when we talk about gamma and the other strike-based Greeks, we know that they're always highest at the money and they decrease in either direction away from the at the money. So the at the money strike has always got the highest gamma. In the money, lower. Out of the money, lower. So it doesn't really matter how we build this strategy in terms of being in the money or out of the money. It's the at the money that decides what your gamma is going to be. Now that sounds easy, but there's a problem. The stock has a tendency to move. As the stock moves to the strike that you're long, you're going to start getting influenced by that long strike. Why? Because that's now the at the money strike. That's the one with the heavier gamma. Meanwhile, if the stock trades up $2 or $3 over the next week, suddenly you could be at your short strike. And you look at your gamma position, you say, wait a second. Last week I was long gamma. Now how the heck am I short gamma? What happened is that the at the money strike has changed. Your long is no longer at the money. Your short is. And when you're short an option, you acquire short gamma. And if that option is at the money, it's going to have the higher gamma. So you're going to have more short gamma than long gamma because the stock is now up at your short strike or down at your short strike. So you have to remember that the at the money is really the heavy when it comes to these strike-based Greeks. As the stock moves from one to the other, your gamma, vega, and theta are going to go from long to short to long to short. Now you might say, hey, that makes me a little nervous because then I really am not really sure my position or my risk. We're in a bear spread. You don't need to panic so much or be worried so much about the Greeks because we already know our risks of the bear spread. We know that that spread can only be as wide as the difference between the two strikes. It can only go down to 0. We already understand our risk on a dollar basis, and we know where those two risks come to fruition. So we're not really so concerned about our Greeks in this spread. Why? Because it's a limited risk, limited reward spread that is well defined as to where those risks and rewards occur and how much they are. So the Greeks aren't as important. I just don't want you flipping out because one day you're long gamma, the next day you're short gamma, only to be long gamma the day after that and short gamma the next day. You don't have to worry about that. But do understand why your gamma is flipping from short to long. Because the stock is moving, getting one day closer to the short strike, where your short strike is now the at the money with the heavier influence in gamma, vega, and theta. The next day, you're going to the long strike, and now that is the heavier influence, and that's the one that's really the heavy in your gamma, vega, and theta. Theta is the same way, and so is vega. These are strike-based Greeks. Whichever one of our two strikes is closest to the stock, that one is going to be the heavy for our gamma, theta, and vega. Up near the long strike, long gamma, long vega, short theta. Near the long strike, long gamma, long vega, short theta. As they bounce back and forth, every time we get the one strike, say the short one, we know we're going to have short gamma, short vega. And we're going to be collecting time decay. We get up near the long strike, it's the opposite. Don't panic. It's a bear spread, and your risks are well defined outside of your Greeks. But remember, bear spread, short delta. What about the synthetics of this position? Well, we know that the bull spread synthetically was equivalent to a collar. The bear spread is equivalent to an inverse collar, the opposite of the collar. More importantly, we know that the long put spread, which is our debit style bear spread, is equal to our short corresponding call spread, our credit side of our bear spread. With these two positions being equal, it offers us a lot of flexibility in how we enter and exit our bear spreads. We can now look at cost efficiency to decide, hey, should I buy the put spread or should I sell the call spread? And you already know what's going to determine the cost efficiency. Which one is going to give us the better effective value? The box. And we're going to talk about that again in a couple minutes. So we can price one spread by the other. We know that if the put spread is trading for 3, and we have a $5 wide spread that we're looking at, then the call spread has to be worth 2. If the put spread's worth 2, then the call spread's got to be worth 3. Together, the two of them have to add up to the difference between the two strikes. So that means if I know that the put spread is trading for 4, I can use that to figure out what its corresponding call spread is worth. If it's a $5 wide spread and the put spread's trading for 4, the call spread has to be worth 1. If it's a $10 wide spread and I look at that short call spread and I say, hey, that short call spread's trading for $8, then the put spread has to be worth 2. That's a very good relationship for us to help us understand whether or not the put spread or the call spread are overvalued or undervalued in relation to each other. Now, we know that this bear spread is a component of the box. And what do we know about the box? And just take this down as a review because it is important. The construction of the box, long the vertical put spread while simultaneously being long the vertical call spread. And these are corresponding call spread and put spread. If you're long the put vertical and long the call vertical, you are considered long the box. Meanwhile, the other construction is also true. Short the call vertical and short the put vertical. Again, they must be corresponding. If they are, and you have both on at the same time, you are said to be short the box. Now, what is the box? It's an arbitrage. In the same way that our reversal and conversion are arbitrages, the box is an arbitrage. It's a position that has no position. We said the reversal and the conversion were combinations of a synthetic position and the real corresponding position. That's what the box is too. One position, the long put spread versus the long call spread. Short call spread versus the short put spread. Since they are related, they can offset each other and create a position that has no position, an arbitrage. Now, how does this help us? Well, we know that when we're talking about the bear spread, the long put spread is the same exact trade as selling the corresponding call spread. So if our long put spread is the same as short the call spread, and we know that a short put spread closes out the long put spread, and the long put spread and the short call spread are the same. If the short put spread closes out the long put spread, then the short put spread must also close out the short call spread. And there you have short call spread, short put spread. If these two are equal, which we know they are, the long put spread and the short call spread, if they're equal, then one gets closed by something, the other has to be also closed by something. If my short put spread can close my long put spread, then my short put spread can also close my short call spread, because these two are equal. And if this one gets closed by this, then that one has to be closed by that also. The long call spread has to be also closed by that long put spread. Same thing. When we see these two up here, the long put spread and the long call spread, same idea. Whatever is equal will be equally affected by the same thing. That's the theory here. So when I'm long my put spread, can close it out by selling my put spread out, normal conventional way, or if I'm long the put spread, depending on the price of the box, I might be able to buy the call spread to close down my long put spread. If I'm short the call spread, which is the other side, the credit side of my bear spread, if I'm short the call spread, I could just buy it back the conventional way. Or, depending on the value of the box, I might be able to short the put spread against my short call spread. Either way, the position is closed down. Now, we know the box can be used to help us accurately price corresponding spreads. We know if the put spread's worth something, we can figure out the value of the call spread. If the call spread's worth something, we can figure out the value of the put spread. The price of one indicates the price of the other. Now, if those prices are at equilibrium, There's no advantage to doing one or the other. You do the one you like best, the one you're comfortable with. However, if they're not in equilibrium, you now have an advantage where you can make a little extra money. Not talking about making dollars and dollars, talking about making nickels and maybe a dime. But every nickel and dime add up. If the box is priced higher than the difference between the two strikes, then I want to do the credit side. I want to sell the call spread in this case, with the bear spread as our topic. If the box is priced lower than the difference between the two strikes, then I buy the put spread, the debit side of my bear spread. So this means that we can use the box to determine our best entry level and our best exit level. Remember, if I can figure out whether the call spread or the put spread is expensive or inexpensive against the other, I have an advantage. I always want to be the buyer, or at least going in on the cheaper side. I want to come out on the more expensive side. We can use the box to determine which is more cost effective on the way in and which is more cost effective on the way out. If I look at it and I say, hey, I want to do a bear spread here. Should I buy the put spread or should I sell the call spread? I take a look at the box. The box will tell me. Box trading higher than the difference between the two strikes, I do the credit side. That means I'm going to sell the call spread. Box cheaper than the difference between the two strikes, then I'm going to do the debit side. I'm going to buy the put spread. And I just do the same thing on the way out, except I want to make sure that I'm getting out at the higher price as opposed to getting in at the lower price. In the same way that the box works with the long put spread and the long call spread, it also works with our other favorite bear spread setup, the short call spread. And what are we going to do? What are we going to add to the short call spread? The short put spread. We can close down our short call spread, our bear call spread. We could shut it down by easily just taking it off. Buy back the May 25 call, sell out the May 30 call. That would take it off. But there is an alternative way out, courtesy of the box. We know that if we were long the put spread, we would buy the call spread to close through the box. Here, being short the call spread, the credit side of our bear spread, we're going to have to short the put spread also. Remember, erase this out and erase this out of your head and just look at the four components. If you can do that, you'll see that in the May 25 strike, corresponding options, we are short the call and long the put. Short call, long put. That's synthetic short stock. Meanwhile, here in the May 30 strike, we're long the call and short the put. Long call, short put. That's synthetic long stock. What we have here is a synthetic short stock position and an equally sized synthetic long stock position. This trade is an arbitrage. This trade is what? A position with no position. That's why the box works. That's why we can shut down our short call spread, our bear call, by selling the put spread. Now, how does the bear spread work? Well, we know that any trade is going to be affected by the three different variables. We can eliminate a variable here and a variable there. We can isolate it and neutralize it. But the bear spread is affected by everything. The movement of the stock is going to affect the bear spread. We obviously want the stock to go down. We'll make money. If it goes up, we're going to lose money. But it's also affected by the movement of volatility and the passage of time. If we want to have time on our side, it doesn't matter which bear spread you do. You can buy the put spread, which is the debit side, or you can sell the call spread, which is the credit side, both being bear spreads. It doesn't matter. As long as you are short the at-the-money option or the option that's the closest of the two to the at-the-money, you are going to be in a premium collection position. That means as the time goes by, your spread will make you money, all things being equal. And in that case, you know what your volatility will be. You'll be short volatility also, won't you? Now, what happens here and why this is occurring as time goes by is because the two strikes will lose their extrinsic value in nonlinear fashion. The at-the-money, which has the most extrinsic value, will lose a lot more than your other option, your long option. That long option can either be in the money, and we have what? The debit spread. Or it could be out of the money, and we have what? The credit spread. It doesn't matter which one. The fact is the at-the-money will lose much more rapidly than either. So either one that you're long, you are going to be in a position where the passage of time benefits you. You're in a long theta position. Now, after this, after the extrinsic value dissipates between now and expiration, we have one other thing, the gain and loss from the movement of the stock. One of these options is going to have a bigger delta. The other option will obviously have the smaller delta. The bigger delta will move quicker and faster in terms of acquiring profits and, of course, acquiring more deltas than the other. That means that if the stock moves in the right direction, we are going to wind up making money as our strike that we have either makes or loses delta faster than the other due to the movement. Now, obviously, the movement we're looking for is a down movement. If we're in the bear spread, the debit one, the long put spread, our long put with the higher delta will gain faster than our short put with the lower delta. At some point in time, as the stock goes far enough down, both options will maximize at 100 delta. At that moment in time, we will hit the maximum spread, which in a $5 wide spread would be $5. For our short call spread, the credit side, as the stock goes down, our short call, the one with longer delta, more delta, will lose faster than our other option, the one we're short, the one with lesser delta. And as that longer delta option loses quicker, we make more money. Eventually, the stock goes down enough, both calls will wind up being out of the money and zero delta. At that moment in time, the spread will be worth zero, and our short spread will have maxed out in value. So when are we going to use the bear spread? Well, when we're looking for a downward movement in the stock. That should be definitely the first thing. This is a directional trade. We definitely want to put this on when we're expecting the stock to go down, not up. Now remember, by adding the element of premium collection, by selling the at-the-money option, we can add to our probability of success. Because if we add the premium collection into the mix, then if the stock stays still, if it doesn't move, we're still going to be profitable because we're collecting premium. That adds to the high probability of our bear spread. Now, there's a lot of stocks out there that are very expensive. And normally, for the individual investor, it's tough to really trade those very expensive stocks. It's too great a drain on capital. But think of the nature of our vertical spread, like our bear spread. We think that a stock, Google's going to go down, or maybe even Apple is going to go down. And what do? Well, at 150, 250, 550, you know, when you take the dollar amounts that big, it's tough for us to be able to short. However, with the use of the bear spread, we know that the maximum value of a bear spread is the distance between the two strikes. That means that the value is never bigger than that. So if we could find two strikes that are $10 apart, we're looking at a $10 wide spread. The most that spread could be going for is $10. The least is 0. Suddenly, we now can get into a trade in a stock that's very expensive because our bear spread is going to be very cheap comparatively. It will be cost efficient. So the bear spread is excellent to use when we're expecting one of these expensive stocks to go down, but the stock itself is too expensive for us to trade. Now, you might say, hey, Ron, what about that stock replacement strategy? Just buy the put naked. I don't know. Try to find an in-the-money put in Google that isn't priced as most stocks are. You find that in-the-money option in Google that we suggest you use for stock replacement, it could be $50, $60, $70. That's expensive. We have to use the bear spread when we think the stock is going down in a very expensive stock. It's also great when volatility is high. Remember that little crunch we talked about? Remember? What was that called? That crunch? Trumpification. That crunch, we said, occurs when we look far out over time or in high volatility situations. That crunch not only crunches deltas, in the right type of constructed spread, it crunches the prices too. Quite often, if you set up your debit spread, your bear put spread, if you set up your debit spread where you're short the at the money and long the in the money, you're going to see that a high volatility situation is going to actually make that spread cheaper. And being cheaper means we have more of a chance to make money as the stock goes down and volatility decreases, because that spread's going to widen up. It's going to get more expensive, and we got to buy it cheaper. Now, this is very important to remember, especially for your bear spread. Why is that? Well, it's true also for the bull spread, but the bull spread requires the stock to do what? Go up. If the stock goes up, what normally happens to volatility? Volatility normally goes down. So we might not see a real opportunity to take advantage of a very high volatility as the stock is trading up. But when the stock trades down, volatility normally increases. We stand a better chance of seeing a high volatility situation in a stock that's going down, a stock that we would use the bear spread on. So this is more so, it's important in both, but more so here because we're going to see much more frequent high volatility situations in stocks that are going down, stocks in a situation where we would use the bear spread. Now that we have a general idea of how that bear spread works, we definitely want to be able to identify downtrends. Because if we find our downtrend and we see it's an expensive stock, we should be happy because that means the stock could have a long way to go, a lot of money to be made there. But if we can't get in it because the stock is too expensive, then you better know how to use the bear spread. So let's find some downtrends.
All right. Well, you did an excellent job there on the bare necessities.
The simple bare necessities.
Right.
I forget the rest of it.
Let's stop torturing our viewers.
Oh, yeah. Well, I'm not a singer. I'll give you that. I'm definitely not a singer. But, you know, the nice thing about the bear spread is that, you know, it's an extremely flexible strategy. It can be set up for premium collection. It's directional. It's a limited risk, limited reward.
Right.
It's actually, you know, the vertical spreads are pretty much my favorite strategies.
Right. And it's a strategy where you can be wrong and still make money.
You got to like that.
Which is good
for
you.
Quite often. Very, very often. But the one thing we do need now is we definitely need to see how we find that short-term downtrend that we're looking for.
All right. So what you want is a bearish trend for the bear
necessities.
Okay. The bears. We're going to show you. So you want me to do this?
I think you ought to do it. I think you ought to show us how you go about finding these, short-term downtrends.
Okay, good. I'm going to go now.
I'm going to stay right here and watch.
Okay, I'm sure you are.
I'm not going anywhere.
Bye.
See ya.